Welcome to episode 43 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Dan Tamkin of Resurgent Capital Partners. Nicholas, what did you think of our conversation with Dan?
I really enjoyed it. And I met Dan at Macquarie Woods in October, and that's when we decided to do an interview. And so I've had a series of conversations with him now, and I find it to be intellectually stimulating. Always enjoy that aspect of it, and also interesting to hear their specific approach and story, which is somewhat colored by being based in California and having more of a venture background. The opposite of ventures is zombies, and this is a topic that fascinates me endlessly. We talk about it very lightly here because Dan's background was to work on venture failures. I learned about the concept of zombies probably a decade ago at this stage. And so zombie companies are, imagine you have a private equity fund, not super well performing, but it returns all the capital across, 9 or 10 exits, and then they still maybe have 1 or 2 companies that are straggling. And so sometimes what apparently happens is that you have these funds that shut down because they haven't performed well enough to continue to raise more funds, but they shut down while some of their portfolio companies aren't exited yet. And so these portfolio companies then effectively become ungoverned. And they may still have management teams in place, be stable cash cows, not bad businesses. And yes, formally, they're still owned by the fund, but they're zombies in the sense that there isn't that full-time oversight and strategic direction. And this apparently presents an opportunity to buyers because now you're looking at assets that are undergoverned, undermanaged, and can be, hopefully, I would think, bought at a reasonable price. And so this is the PE analogy to what I think Dan has experienced within the venture field, where he talks about venture failures. And it was just a topic we touched on that I enjoy. And I haven't really seen it a lot, frankly, since I learned about it a decade ago. But I'm eager to find these zombie opportunities because intuitively they seem like they will be good ones.
Nicholas, one of my favorite parts of the interview was your back and forth with Dan around the analysis, the financial analysis of the returns of buying small $2 million EBITDA business. You guys walk through the math of what it would look like to buy a business that does $2 million of EBITDA, call it $10 million of enterprise value, doubling the enterprise value over 5 years and what that return looks like, which is basically $2 million, 20% carry on $10 million of equity. And how, especially for partners, that doesn't actually seem like a very good use of time. Over 5 years, 2 guys, lots of risk, lots of hard work. Pretty stark explanation of how to be careful about the size of business, about going too small. Of course, you can make it work if you aren't doing the independent sponsor model with only 20% carry, if you own a lot more of the business, which is common in Searchland. And I think Dan and his partner also are owning more of the smaller businesses. But just a great walkthrough of how the numbers really break down at smaller size deals, $2 million of EBITDA and below. Max, what did you think?
Well, I definitely don't want to work at a zombie company. That sounds like probably not the best work environment. However, interestingly, it certainly does create an opportunity from an investment standpoint. And I think we've seen carve-outs of larger corporations, even sort of certain segments of that company sort of behave like a zombie company and can be carved out, and investors can get some of the some similar benefit to what would be a zombie company in investing in that. But what I found really interesting that Dan highlighted was related to emotional quotient, EQ versus IQ, as a differentiator when he's investing and when he's speaking with sellers. So not only does Dan's high EQ allow him to build confidence and build trust with sellers, it also allows him to gain valuable insights into the deal, and it gets sellers to tell him things that they, might not otherwise say at a management meeting. So Dan's high EQ helps him to build trust, and it helps him to gather information that can be valuable in the deal process, such as how the employees are motivated, and if the employees are going to likely stay after a transaction. These are all things that are equally, if not more important than the numbers in the deal.
I liked his phrasing, put your phone away when talking to sellers. I liked that while it's kind of obvious, because I think most people think they have EQ, and most people probably approach conversations with sellers as, okay, I'm going to be a nice, respectful person. I'm a professional, and this is their life's work. This is all very obvious stuff. I think, though, what can be tempting, even for people who think that they're already doing the right thing or demonstrating EQ, is the temptation of multitasking. It's just so hard for all of us to remain good, active listeners in any conversation because we just all got too much going on. Just a good reminder, we all think that we're good guys, nice people approaching these conversations, but we may be distracted and not even realize it in ways that come off as disrespectful or off-putting to owners. So even Dan himself says, we probably do it right half the time, and half the time maybe we are the ones also coming off as, not as high EQ as we'd like. So a really good call out there. Well, before we get to the interview with Dan, our regular reminder that Minds Capital is investing equity in independent sponsor deals. So if you are a sponsor with a deal under LOI, submit it to us. You can find the information at our website, mindscapital.co. And if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for accredited investors. So if you are an accredited investor, you can fill that form out to be kept in the loop on Minds Capital raises and becoming an LP. Here is episode 43 of the Minds Capital podcast with Dan Tamkin of Resurgent Capital Partners. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Dan Tamkin had been sitting on the domain name Resurgent for years, finally put it to use as the website of his independent sponsor firm, along with his partner, Bryce Winkle. Since then, Dan and Bryce have acquired 6 platforms, 3 of which were turnarounds. 3 of them were small enough that they could buy and own them outright. The other 3 were larger and structured more conventionally. Those that they own outright were a key source of cash as they got things off the ground. We will get there. But Dan Tamkin, welcome to the Minds Capital podcast.
Oh, thanks for having me.
You had a previous career, Dan, in buying failed venture companies. Today, you don't think that that's such a great model as an investor. Why?
Yeah, so as you mentioned, I had the domain name for a long time. It was actually originally resurgentventures.com, which I think redirects to the current domain. And I had bought out kind of my first entrepreneurial endeavor. I'd bought out a failed startup, decided to turn that into a career at my prior fund. And one things I learned is that kind of hope is a dangerous drug. And in the venture world, they really like hope more than the realization of a bad mark, because you never know, maybe something will get bought for stock and that new company will take off, or something will happen that will give them that outcome they were hoping for. They don't really want to mark down that company. The other piece of it is in most venture-backed companies, you have 3 or 4 people that own it. So there's no key decision maker. And so there's a bunch of competing interests depending on where they are in their fund, depending on how they are doing in their own partnership. Are they one of the partners that's doing really well? Or are they marginal? Again, do they really want to take that mark down? Do they want to kind of give up on hope? So you end up with a lot of competing interests. And then finally, the business itself, get shopped a ton, right? So there's a bank working that deal and working that deal. So every strategic has seen it. So it's a pretty tired deal out in the market already. And so if you grab that asset, you might be able to get it cash flow positive, but in the time that you're getting it cash flow positive, you're falling further and further behind the market. And so ironically, the cash flow positive company is less interesting to the strategic than the company that was burning money but was at least market leading. So I think there's just kind of a number of factors that I learned over time that came together to make those deals. One, difficult to get done, but two, once you executed them, you could create cash flow, but you never really created any what I would call EV, right? You never created equity value for yourself. You were kind of just pedaling on the bike to get cash flow to reinvest and trying to catch back up.
It's interesting, Dan, to hear you describe it that way, because it sounds like it's the intersection of VC and private equity, where you have a VC, still an asset that's going to be basically judged or valued by the market as a venture asset, one that where they only care about top line market traction, growth, adoption, and meanwhile you're turning it into a PE asset, a cash flowing asset that you might sell for EBITDA. And it sounds like there's just a mismatch there that never quite gets reconciled.
Yeah, I mean, because fundamentally the value of the companies is more about the marketplace they're in and what's going on in that marketplace.
Mm-hmm.
So if there's a lot of rapid and fast change, kind of being a cash flow oriented business is very tough, kind of that quote unquote lifestyle business, which is the nasty word for it in venture.
Mm-hmm.
And then, on the other side in PE, you're looking for stability. So if the market's changing fast, kind of by definition, you don't have a stable business that you can feel good about the cash flow such that you can underwrite debt and kind of more a typical PE strategy, kind of LBO, so to say. Mm-hmm. So you kind of get caught in this no man's land of being kind of a small business owners.
Yeah,
in a rapidly changing market.
Well, it is. This model is one that you see from time to time. There are shops that specialize in buying these venture assets because the thesis, of course, is that they're not going to be they're not going to provide the outsized return that venture needs for them to be worth the venture capital fund's time, but that there is still intrinsic value there, and in that delta is where there can be value creation. But anyway, great to hear from the front lines why the model is pretty challenging. Dan, you have something of a tech background, so give us that background. That I think that makes you a little bit different than our usual guest.
Sure. I mean, I come from more the operating side of businesses versus the deal side. I built and sold a software company, was the CTO of a couple $1 billion company, also built a $100 million division for that company, doing kind of like paratransit operations, and then spun out and did the venture turnarounds we talked about in my prior firm, and then kind of took all that experience around, instead of looking at a deal that had 7 things wrong with it, someone came to me and said, why don't you look at these lower middle market deals, which might have like 1 or 2 things wrong with it that are fixable problems, and you could apply that same trade there and not play so much hero ball here on the venture stuff, and actually create a little bit more of a real business for yourself that has a long-term view in it. And that person was our partner, Bryce, and he was correct.
Mm-hmm. And so what did the early days then look like for the two of you?
I think we were still really interested in kind of that fallen venture model. And it took a little bit because it was so frothy when we started, and kind of like 2017, that we thought eventually it would fall, and then obviously the venture market took a long time to fall, and now it's aggressive again. That we really focus on those assets. Nothing ever really kind of fell to us, and again, as I pointed out before, they were kind of poor quality businesses that were there. That we just decided that we should really focus on the lower middle market. We were also very lucky early on. I was on the board of a company that was sold, and about 6 months after it was sold, kind of encountered some distress. So I was hired at a very high rate to come in and clean this company up, which obviously I had extensive experience as CTO and as a turnaround guy. So I was kind of the perfect hire, and I knew the business. And did that for 18 months, and frankly, gave Bryce, we were 50-50 partners the whole time and always have been. Even though in a new partnership, gave Bryce half of that money, And he was building the firm while I was doing the turnarounds. And I think the thing what I always talk about the most about the beginning of Resurgent is how much at an early stage Bryce and I had a lot of trust and faith in each other. At this point in our life, he bought a home a few years ago. I had to sign a bunch of documents, right? If I bought a new house, I'd probably have to have him do the same. We're so intertwined in each other's lives because we've been building these businesses together that I think the most important thing if you want to build a long-term partnership with somebody is to go first on the trust side, right? And so between really early on, instead of just trying to pocket this cash on a consulting deal for myself, which I guess I probably could have done, my thought was never, how do I make a bunch of money on a consulting deal and then what? My thought was, I want to spend the next 10, 20, 30 years of my life. This is my quote unquote last job. And I want to do it with somebody. How do I build that, not just kind of take the short-term money?
Yeah. So essentially you were being very well compensated at this as a turnaround gig contract, and that you use that capital to essentially be the seed capital of Resurgent that Bryce was using for his own, ramen.
Yeah,
right?
well, it
living
gave
expenses.
us the runway, but also building out BD functions, traveling, all the things that there's just something different in life when they ask you to come to a management meeting and it's coming out of your personal bank account versus it's coming out of the quote unquote business bank account.
Mm-hmm.
And look, I mean, it's all an LLC. It all flows to you at the end of the day. But it's just a different feeling when that bank account says Resurgent Capital Partners versus Dan Tamkin or Bryce Winkle on it. Just easier to spend that money, I guess.
Dan, so there's a lot of interesting kind of details to your early days, but let's hear now about how buying small early to fund the search for something larger, essentially, which we kind of characterized as bootstrapping the independent sponsor firm.
Yeah, I think that the first thing I want to point out is whether it be the consulting gig or kind of the early deals, you start with an idea what you think your firm's going to be, and then you kind of get the reality of what it can be, and you just kind of figure out the way to make it happen. So I don't think, like, if I had to do this all over again, I don't think I could walk the same path because there's a bunch of things that happened that I didn't know was going to happen. I couldn't have planned on that. So it's not necessarily that we set out for small deals, but what was said to me by a friend in PE is like, we do kind of crappy deals because they're the only deals we can do. Right. And look, there's a joke in there. We don't think our deals are crappy, but the point is they're not $10 million EBITDA deals that are perfect, clean deals with no customer concentration or supplier concentration in fragmented industries that like the typical things you'd see on a, upper market PE firm's website about what they're looking for. Generally lower middle market, there's kind of like some type of fixable problems, I call.
Mm-hmm. And so what did the first of these not sterling businesses look like that you bought?
Well, so we bought a freight brokerage in Omaha. It had 40% customer concentration. And actually on a freight brokerage drags the cost of goods across the freight cost across the P&L. So really, these look like big businesses, but they're actually kind of, their gross margins, their real revenue, because the transportation is provided by a third party. So when you went on a gross margin basis, that customer was actually 70% of revenue. So it was pretty hairy early on. And then shortly after we bought the business, there was epic flooding in the Midwest, and it was very tied into the soybean plant. And the soybean plant was basically so soybeans planted and then harvested. It was tied into the movement of seed and all that too. It was all wiped out. So our first major season of it had some seasonality to it as well. We lost out. So
trucking meets agriculture meets a bad season.
Yeah.
And how big was this business?
It was a couple million EBITDA. So what happened is that this gave us credibility. We got deal one across the plate. It was actually set up as a full mezz structure where we would put in a sliver of equity, and we would own the entire thing. And then what happened is mid deal, the kind of air came out of the trucking index, and what happened is the financials started kind of falling off a bit, and we were buying it at a pretty good discount to what a freight brokerage usually goes at, which was ultimately our saving grace. So buying it right was the key. We were able to flip and work with a family office to go do an all equity deal. So our first deal was all equity. And then during COVID, we got a great offer that was more like a market multiple for the company. So it ended up being a pretty successful exit, a 52% IRR net of fees.
Oh,
I mean, it was a short hold on not a massive amount of money, but still, in the early days, Bryce and I always talked about how do we just get in the game. Again, if you have a long-term point of view, how do you just get in the game? And then because of the consulting gig, we had the cash flow to survive long enough. So you're infinitely more credible when you've got deal one done, and then obviously the credibility on a ratio basis goes down as you get more done. But obviously, you continue to build overall credibility. But there's a big difference between zero portcos and one, right?
When you were imagining this long-term vision, what is the vision for Resurgent?
Yeah, the idea was get small companies and big companies and kind of avoid what I would call the messy middle for an independent sponsor. And that is, and we learned that off the trucking deal, was that if you get in a $2 million EBITDA deal and you are going to push it to, like, let's say you do a great job and you push it to 3 or 4 million, especially nowadays with things being a bit more expensive, you're not creating that much equity value if you go do the math. And then after you take the pref into account and all that, if you take 20% of that and you got a couple partners, and then you look at the management fee of 5% of a company like that, it's actually not a lot for you to create a firm on, unless you're able to stamp one of those out every 9 months or so, which is typically pretty hard.
And Dan, let's unpack this a little bit. So
sure.
In the middle, where you EBITDA of 2 million and taking that to 4 million, the economics to you guys, to the sponsor, are not great. But at larger deals, but also I'm intrigued by also at smaller deals. In fact, the economics can be good, I guess, because you own that much more of the business.
Yeah, I mean, once you get above 5, you get more multiple expansion. But if you're buying around 2 and you're still sub 5, you're not going to get much multiple expansion.
Right.
Unless you've changed the growth trajectory or something exciting's happened in the industry that makes it more desirable. So fundamentally, you're going to do a lot of work on that asset because it's pretty small. It's not going to have a lot of management. It's not going to have a big team in it. And it's going to kind of, especially if you're a single person independent sponsor. In our case, we're 2, and we have a principal nowadays, so we have 3. It kind of blocks out the sun once you get a portfolio company. So it really slows you down towards getting to the next deal. So for instance, I spend 100% of my time on portfolio companies. Obviously I'm one of the founders of the firm with Bryce, so I spend time on new deals. But I have 2 portfolio companies. I spend most of my time on one more than the 2. And it really, as you build a portfolio, it just takes a lot of the time that you have to go do new deals. So you got to make sure that when you spend time on that slot, it ends up being worth the time.
Mm-hmm. But let's walk through the math there a little bit.
Sure.
So, because you said these days it's more expensive. So let's assume the $2 million EBITDA company is acquired at 5x. So that's a $10 million EV. And then you said if you do a phenomenal job as a sponsor and you double that over a 5-year period, it's a lot of work, but you've gotten it to 4 million now. And presumably you can still exit at 5x at least, maybe even slightly higher. If you can do 5x, so same multiple on the way out, you're now looking at 20 million EV. And of course, the gain there is all equity. And then if you pull that out, if you had full catch up after an 8% hurdle with a 20% carry, you've now made $2 million. And that is your point, I guess, that if you split that 2 or 3 ways across 5 years for all the work you put into it, it's just not worth it for $2 million.
Yeah, I think part of it is, 2 guys living in California that used to, I was a CTO of a big company. Bryce worked in private equity. So maybe different compensation needs. If I was living in the middle of the country and it was my only portfolio company, it might be a little bit different. But yeah, fundamentally, if the deal blocks out the sun and it's kind of like a middling, I would say it's more like 3x, right? Because it'd probably be 5 million in equity on the entry and then 15 at exit. Let's just assume the debt, you didn't pay down the debt along the way. So you're creating 10, right?
Mm-hmm.
And so if you're creating 10, and then you're probably not going to end up with 2 million out of that, just the way the market is right now. You probably end up with like 1.5. And then in California, you're probably paying down to about $1 million in taxes, taking off federal and state. Now maybe you can get QSBS or something like that set up. So you're looking at $500K a partner for probably 3-4 years of work. And yes, you get a management fee along the way, but a management fee on what's called the middle 3 million is do the math quick. Is it 150? Yeah, it's 150K. That's usually about the floor that you set on an IS deal. So the math just gets skinny. So it's either, hey, I can get a smaller business that I own a bunch of, and really there's no carry because I'm the owner, or I can get a bigger business. I mean, obviously it takes time. Getting a bigger deal done, it's rare to walk out as an independent sponsor unless you're walking off a big platform to get a $10 million EBITDA deal done as your first deal, right? That's
and so
pretty
what
unusual.
is big enough then?
Probably where you're pushing above 5 in EBITDA. It would have to be pretty growthy to be below that. Because again, like the way the market's set up is, 0 to 2 is a lower multiple than 2 to 5, and 5 and above is a higher multiple than 2 to 5. So you want to get your multiple arbitrage, you want to be pushing through one of those levels during your ownership.
And your strategy is deliberately to go for the deals that are small enough where you can just do it all in-house and earn and own the cash flow, or big enough where it moves the needle for someone living in California. But you avoid then the 2 to 4 million EBITDA range as the entry area, which is frankly where a lot of independent sponsors play. Is that because you're a partnership? Do you think it's okay for solo sponsors? Or do you think it's not okay even for them? Or what if you're a triple partnership? Would you need even a bigger cutoff?
It's a good question. I think on the 2, so 2 is definitely too small. 4, I don't think is too small as an entry, because again, you're close to that 5 where you can push over. When it comes down to the size of the partnership, a lot of that just comes down to what are the needs of the people in the partnership. If you're, very early in your career and you don't have a family, you don't have a mortgage, it's an easier time, right, to take risks than when we started kind of later in life with families, mortgages, kind of expectations of a lifestyle already built. You want to service that lifestyle and while being able to take the risk. And so it just made more sense for us to play small or play big, because that kind of worked for us to backfit into our life.
And Dan, so most people listening will not need convincing that bigger is better. But walk us through how one of these small deals can be worth it. Are we talking like SBA, searcher style?
So because of the stage in life, we stay away from the SBA. We just stay away from personal guarantees. A quick story on that is, we bought our tanning salons, 30 days before COVID. And if we had SBA'd that deal with PGs, we would have been in a big problem. And we were able to figure that deal out, and it's healthy and good today. But the stress would have been unimaginable, right? And nobody could have predicted COVID, right? When we closed on February 5th, and then by, I think, March 18th, we were shut down by order of the health department because of COVID.
Oh my God. So
my view is you just never kind of know in life. And I like the idea of individual economics and deals standing alone. And so taking a PG kind of violates that concept. So we just don't, it's just a hard no for us. We don't do them.
Fair enough.
Yeah. So on the smaller deals, what we've looked at is, buying between the 3 we've done. One was a partnership dispute in COVID where they needed some, a little bit of capital from Bryce and I, and they needed some cleanup in terms of their internal operations. Another was a pay to take of a small division of a big company that they were tearing down the whole division and they just wanted it gone. And then another one was kind of a management team that had aged out and was a break-even company with a great customer base and strong revenues, but just, kind of they just needed an exit, and they they had some very peculiar and particular ways they wanted to exit, and we were able to kind of answer the bell on that because we, again, didn't have professional money that we had to answer to a certain way of doing a deal. We were able to kind of get creative to make it work.
And so when you buy these small deals, give us an example of one of the structures. So no SBA, no PG, probably a lot of your own balance sheet, but maybe it's so small there's a lot of seller note, or what does that look like? Give us an example, perhaps.
Yeah, I mean, you're trying to find So when it's small software companies, there are lenders out there who will lend against the recurring revenue, the ARR lenders, so to say. So that's a big piece of it. And then we put our equity strip beneath that. And the equity strip's pretty substantial, right? It's not, here's 50K. You've got to lean into it and really kind of believe in the asset and believe in your ability to operate it.
What sort of percentage?
Probably about a third. So about 2/3, 1/3 is so about 2/3 from the AR lender and 1/3 from our own balance sheets.
And the lender against the ARR from the SaaS business, are those terms reasonable, not onerous?
There are certainly some out there that are quite onerous, and you got to shop the market hard. We've been fortunate to find people that are low teens debt, no warrant, and have good. The other piece that usually kills you is the AM, and a lot of them have been no amortization or straight line. Straight line with a significant tail at the end of the life of the loan so nothing that would kind of crush the company. In all cases, we've paid off I think the longest we've ever had an ARR lender in one of our deals is 18 months. So we know the plan. We know what we're going to do with the business. Of course, you always encounter things that you're not sure about. But every time we've been able to execute the plan properly and be able to get the lender out pretty quickly such that we own the business. And then from there, we can reinvest and grow the business or do whatever we feel like is the next phase for the company.
Do those deals still exist in 2025? Small software deals that can be financed out of pocket like that? Or are they much more expensive now than when you started?
Those software deals aren't more expensive because they're not usually rep by banks. They're kind of weird oddball processes. I mean, there's one we're looking at right now. That's a small one like that. A lot of times, I think a fruitful area for that is carve-outs, especially as if the market cools off more and more. What you're going to find is changes in strategies from public companies, and they might have, a services organization that for some reason bought a software company. It's going to be an odd fit with new leadership or a change in direction on leadership, and they're just going to want it gone.
And so this seems pretty linked to what you did initially in your career when you were doing failed ventures. You're now doing carve-outs and software misfits, so to speak, and you're taking them over, and they're small enough that you can apply your technology first skill set, and you have enough of a balance sheet where in the small cases you can buy them outright. How soon are you able to generate dividends from these small deals?
Well, we get a small management fee to start, and then once the debt is gone, it's kind of ours to either grab the cash flow or in many cases it's reinvest. So we're making the changes up front, and let's say that 18 months to get the cost basis correct. And usually there's always a cost problem in the beginning. And then what we'll do is start reinvesting. All these companies are behind on technology, so we replatform them and reinvest in the technology. And then we, along the way, we're learning about the company and trying to understand what opportunities there are for growth. And then from there, when the replatforming is almost done, we bring in kind of like a chief revenue officer or someone to kind of restart the sales engine.
Could you re-explain the replatforming?
Sure. So we bought a company 2 years ago that their entire technology stack was in Delphi. Pretty hard to find people that understand Delphi. We're comfortable with those risks on replatforming in terms of how do we get to a modern technology stack. We're comfortable kind of starting from scratch and building it all over, over time, migrating the customers over, and having a platform we can build to the future with. We don't view those. We're not as scared off by those technical risks, I guess, as other people might.
And initially, when you said that instead of looking for companies where venture failures, where you have 7 things that are wrong, we now look for things where there are 1 or 2 things wrong. Would this be an example of that?
Yeah, I mean, so you're buying a company that's stable, right? The customers are stable. The product works. The customers are happy on the product. Maybe there's some issues around how they've, like the last 2 deals ago, the way they were spending a bunch of money on the back office. They were overspending on some of their basic telco expenses and things like that. Those are ways we were able to just kind of create some cash flow. So those are kind of the fixable problems that you're seeing immediately. And then the question is, can you restart growth? And so if we get the fixable problems done, we know we're going to create an acceptable return for us. That's going to be, frankly, pretty exciting. And then the home run is, can we get the growth engine restarted? And that's generally new products to existing customers is the way we're trying to get there. We try to avoid new products to new customers. And I should say new products to new markets is probably what I really mean there, because that's the highest risk. People we don't know to products we don't know to people we don't know is tough.
I feel like replatforming software is a huge, you've already said it, it's a big risk and a huge expense. Is this typical in the, constellations of the world when they're buying a SaaS business that it's old and all kinds of technical debt, and so they rewrite the whole thing?
Yeah, I don't think that's like Constellation Strategy or a bunch of the other aggregators. In our case, it's our strategy just because that's the only way to move the company forward. Otherwise, you're just kind of buying a revenue stream that'll eventually go away.
Mm-hmm.
Eventually, a competitor is going to come take that away. So my guess is, Constellation and them are buying something that's probably on a more modern platform, whereas we're kind of willing to take those extra risks, just given how long I've been in technology and having been CTO of a big company, having been, kind of CTO, CEO of little companies. I guess for me, it's something I'm just comfortable with.
Yeah. Well, it's obviously it's a huge differentiator to have an independent sponsor who's comfortable rewriting or having rewritten the entire code base of a SaaS platform. That is not something that I didn't see a lot of people like that at McGuire Woods. So pretty interesting.
Yeah, we probably wouldn't pitch those types of deals at a McGuire Woods. I think when you're at McGuire Woods, you're, as much as I might like a deal, when it comes down to the bigger deals, I can love a deal, but if the capital market doesn't see it the same way I do, then my opinion doesn't matter because I can't get the deal done without them, right?
Yeah.
So when you're looking at the bigger deals, they got to be cleaner. You're probably not going to come in and rewrite the platform. They're not going to want to take that risk with you, despite whatever proof I may have in my background. So that's kind of the difference between the smaller and the bigger deals. The smaller deals, you're getting certainly more hair on. The McGuire Woods level deals, they're going to be pretty clean, and they're going to have some problems maybe in the way they were shopped. Maybe it was a bad bank repping it. Maybe it was a bad process. Maybe there's a challenging owner. There's going to be some story to it, but you want the story as to why you're getting some value to not be central to the asset having a problem. You want the story to kind of be a reason that people are uninterested in the deal, but also something that goes away once you get the deal done.
Dan, you mentioned that upfront, Bryce, and you were adamant to get in the game. And you have a grown-up, mature lifestyle to support. You have working capital of an independent sponsor boutique here. And you want to, of course, grow the startup that you're starting here. And so initially you started with a consulting gig in order to have cash flow. You partner with Bryce, 50-50 structure so that you have boots on the ground and you have the cash flow. Later you talked about how you used cash flow from small businesses that you guys fully owned and you were able to buy. If we can peel the onion a little bit on the ladder, because when I pressed you on that a few minutes ago, you said that, yes, once you've paid down the debt, then we start to reinvest. But my understanding of your journey had been that no, these cash flows were quite important early on in your journey. And still to this day, it's why you maintain this small deal, big deal strategy, but nothing in the middle, because you view them as cash cows. So can you kind of reconcile those items?
Yeah. So the second deal was a pay to take, so there was no debt on it, and we were able to get that company profitable immediately. It's kind of one of those stories where a corporation looks at a business and puts a bunch of overhead on it and says, "Well, this business is losing $700,000 a year," and I look at it and go, it's probably break even, right? And with some small changes, it'll be making, maybe $500K or whatever. So that was kind of where we got some cash flow post the consulting gig, was just being a bit sharper, looking through the financials in this carve out.
Way on top of the conversation, you talked about tired deals, that failed ventures, they're often shopped around quite a bit. And so by the time you see them, they're tired deals, is what you said. And in the independent sponsor world, we often hear about broken processes, and that this is kind of the prime spot to pick up overlooked deals, is that you come in after a process has failed. So what are the differences there? Or should independent sponsors stay away from broken deals?
No, I think it's different based on the segment. So definitely broken processes is a great place for independent sponsors. When it comes to strategic acquirers, which is generally where venture exits are trying to be, is that the strategic's already kind of seen this asset and they've passed on it. And it's tough to get back in the room with the strategics with the same deal, a year later. They've already made that decision and they're already looking at new targets. It's actually the same reason, I guess, for independent sponsors that broken process is a great piece, because if you go like a lower middle market fund or middle market fund, if they've seen a deal, they actually have kind of the same gig going on where the partnership's already passed on the deal, so someone's loath to bring it back again. It's really why how you take your company to market the first time is really important, and I think a lot of sometimes business owners miss that, and that creates opportunities for independent sponsors.
Okay, so it's not really an apples to apples comparison.
No, because I think they rhyme, but I don't think they're the same.
The other day, I was reading an article that one of the senior guys at EQT, one of the large companies, says that this, we all read all these headlines about private equity. There are liquidity issues. They're not really redistributing capital to limited partners these days, and it's drying up and creating liquidity issues in the industry. And so he was saying and stating that he believes a lot of funds will be shut down. And in the process, we will end up with zombie deals, where I think the dynamic might be somewhat similar to what you may have seen in the venture world. Could you explain to us what are zombie deals, and also how could they be an opportunity for independent sponsors?
Yeah, I mean, from what I have seen with the zombie deals, it's generally because the equity value of the company is basically zero. That it's worth about what the debt is at, and you have to kind of then make a deal with the debt. And by making the debt whole, you're kind of overpaying for the deal. And so you're kind of stuck in the middle unless you can get the debt to play ball with you.
What's kind of the classical definition of a zombie deal?
I would think of one where where maybe certainly an initial business plan wasn't hit, so it's over levered. There's probably little to no equity value. And then, on top of that, you have kind of abandonment from the fund side, because most people are looking out for either raising the next fund or they're looking out for where they're going to go after that fund concludes.
That resonates with my understanding. It's, let's say a PE fund has 15 deals. They may have exited 14 of them. And then they have a poor performer, but not a donut that is still sitting there. And it doesn't really warrant anyone's attention. And the fund overall perhaps didn't do so well. So the principals have moved on. The GPs are no longer active. And so you end up with the concept of these companies that have management teams and can be stable. And they really don't have governance, and you're now looking at a decade in. But they still exist. They're still businesses. They're still generating profits. And that's where I've heard there could be an opportunity for sponsors, especially people who are comfortable, like you, with looking at assets that may have been abandoned by others, so to speak, right?
Yeah, we've looked at a number of those, usually in concert with MES or SBIC funds. And the challenge always is, if you fully pay the MES or you fully pay the SBIC, you're kind of you're paying a valuation that's more than the business is worth on the market. And so you need to figure out a way to get the debt to play ball and to work with you. And that's a bit of a challenge sometimes. That's why I'd probably say we've seen a dozen of those, and we've never closed on one because we always kind of get stuck in that same classic trap.
How do you find them?
We do shop our turnaround expertise to the Mez and SBIC community. We're talking to them actively on deals we're pursuing, so we can sometimes turn the conversation around and say, hey, by the way, if you have deals that's not performing, or having an issue, let us know. And then they'll send us some, because of our background and our track record, and obviously they know our story. We get sent those deals. And what we try to do with people is, respective of whether we're interested in the deal or not, is we provide the advice on what we would do if we owned it. So even if it's not a deal for us, we try to at least be helpful. In a number of cases, we've been helpful, and at least twice, I think people have gotten full recovery for a deal we couldn't do because economically it didn't work for us. But by giving them some tips on how to manage it, they were able to get full recovery and not have a write-off.
Okay, so this is an example of how you guys are paying it forward, so to speak. And I think in our pre-call, you mentioned something adjacent to this. You said that IQ is, everyone has IQ in this industry, but EQ is more differentiated. What did you mean by that?
Yeah, I once asked a banker, why did you choose us for this deal? And thankfully, he had the good sense to say, you didn't pay the highest price. But he said, like, you guys show up at management meetings, you ask interesting questions because you care, and you put your phones away. And that seems like a super low bar. But I've now heard that about our firm probably 4 or 5 times. So I think there is something to, being really interested in what this business owner has built, because remember, it's their life's work you're staring at. It's the biggest moment in their life. It's the biggest transaction they're probably going to do. So while they're not going to take, $10 million less because, we listen better, probably in a tie-breaking situation, they will pick us. Or maybe we listen better and we see an opportunity to cut cost or do something to, kind of create an instant win on the revenue side, and that might allow us to pay up a little bit more.
Why can you pay up more? Because you're socially intelligent.
Because in the course of a conversation, and the best conversations, by the way, are always at dinner, that they're not at the management meeting. You want to get to know people personally, but in the course of those conversations, you build some trust, and they'll say some things that might go, well, actually, if they're paying this much for that, from my experience, or I have a friend in this industry or this, I know they could actually probably pay a lesser number for that, right? And you kind of see these patterns. I'm pretty sure everyone's business could be cost optimized. We're pretty good at cost optimization. I'm 100% sure if one of you guys walked into any of the Resurgent businesses, you could go, oh, you could save money here, you could save money there, you could save, it's just because at some point you've driven so much and you've done so much, you maybe not willing to go that extra layer where a fresh set of eyes might see it.
But going back there, you said that if you go to dinner with someone, so you go beyond the normal conventional management meeting, that's where maybe you can uncover some diamonds in the rough. And these diamonds can be opportunities to you where the business owner didn't even think about it as a growth lever, perhaps. And because you now observe and have uncovered a growth lever that maybe nobody else has, this will enable you or compel you to bid higher. And so it makes you more competitive if you can create that very close bond, because you also get an information advantage.
Yeah. And look, deals are done by trust, right? And deals are done by trust, and they're done by confidence. And so the more time you spend with somebody, hopefully you're building trust and inspiring confidence. Obviously, if you don't trust the person, you shouldn't do a deal with them. So for us, it's kind of a big advantage that maybe we don't get in that meeting when we're building the trust and the confidence, the exact thing we're looking for. But because we spent that time the night before, maybe the next day we learned something. These are, like I said, these are relationships. These are massive transactions for these folks. Having been on the seller side before, I certainly understand that piece. So I just think there's a big piece of the emotional intelligence of just respecting that person's life work.
It's interesting to me because this dynamic, we hear a lot that private equity guys come in and are distracted or on their phones or not giving due respect, frankly, in some ways to the founders and sellers. And what's interesting to me is that it's kind of like everybody knows that nobody wants to be that guy. And so most people that we talk to are savvy enough, and I don't mean to say that it's not genuine, savvy enough or genuine enough to give the seller and the founder their due. So I have yet to meet the person who's actually the one who's on their phone and who's the jerk, who's the PE jerk. No one claims to be that one, but everyone talks about how the whole industry is populated by those types of people.
Yeah, I mean, my guess is we take turns being the jerk, right? Sometimes we're just the way life is. We walk into a meeting distracted, and I'm sure there's meetings were better than others. And just like I'm sure there's other firms. So I don't know if it's like, hey, we're the jerk firm and we're the not jerk firm. Some of it's just the ability to kind of manage yourself better for that couple hours.
Yeah, exactly. That's a good point. Dan, we're wrapping up here, but could you give us a story of Sonet?
Yeah, sure. So we bought Sonet a couple years ago. Provides payment systems for state and local government, and provides kind of for free all the ways that a constituent pays. And so it kind of makes its money taking credit card payments and ACH payments. Business had been around at the time we bought about 30 years, was kind of stuck in the sense that I had the same customer base probably for the last 10 years, probably didn't win a customer, didn't lose a customer. But the business had, the technology was just kind of very far behind the times. And the team was kind of a bit rudderless. So an example there is they were, they send out maybe, 20, 30 invoices a month, and they had about 500,000 in accounting spend to send that out. They had, they were overpaying for their call technology budget by about 6x. So there were a lot of easy wins. We could see that we could make some cost adjustments to kind of reduce the administrative side of the business, which was kind of being run like a Fortune 500 company almost, despite its small size. And then take that money, as our normal strategy is pay down the debt, build out the technology platform. And then today we've just hired a chief revenue officer that's now starting on the growth plan. So really just kind of going through the three phases of our investment life. So it's the first piece of it though was we saw places that we knew we could cut costs. And if we couldn't, and if it doesn't work out trying to grow the business, we know that we're going to get a very acceptable return. And if we can grow the business, it'll be an explosive return.
The quality of revenue of that business must just be absolutely, only thing certain in life is death and taxes and parking tickets. And that money's going to keep flowing into the government. And I just imagine it's super, super sticky that they're not going to rip that out once it's already in there.
Yeah, it's sticky. And then the big thing is the team there has been phenomenal at customer service. And when you think about state and local government, the key is be phenomenal at customer service. And so we're letting them be great at what they're great at. And then now we're trying to augment it by reinvesting in the technology. And then we want to sell great technology, but we need to sell great service too. And we feel like we've got the great service. We're about to have the great technology, and hopefully we've hired the great sales leadership.
As you transition with this deal from what you call the acceptable rate of return zone to now hopefully going for the explosive rate of return zone, how well does the trajectory you've had so far match the pro forma that you had before closing the deal?
We're ahead of the pro forma before closing. We had some good surprises in terms of being able to reduce cost and some revenue wins we didn't anticipate. We are very early stages in seeing how the sales plan is coming together. We're only like a couple months in, but I've already seen pretty good returns from the guy we brought in, so really excited about him. I think one of the things is that generally the credit card business, ACH business is often populated by people that are trying to serve a lot of people in a lot of different industries. And service is, as a company scales, it's hard to provide good service. And so we feel like we have a real competitive advantage with just the core ethos of the company. Again, which is part of what we acquired. It's not that we necessarily built that service discipline, but if they didn't have that service discipline, we wouldn't have bought it, and they wouldn't have been around anyways for us to buy it.
Dan, to close out, just one other theme here. You mentioned earlier the lifestyle business and how that's a dirty word in venture land. But in fact, I think you've evolved because you and Dan really have built the firm to enable a particular lifestyle. Share more about what you guys are building, not just financially or number of platforms, but really to facilitate your partnership in your lives.
Yeah, I mean, obviously, we're all people outside of work. Growing up, my dad traveled a ton, and he wasn't around a lot. And I had a great relationship with my dad. So it's not to like start down that road. But I wanted to be around, and Bryce wanted to be around. And so a lot of the beginning stages of Resurgent, while we've definitely hustled and worked hard and done the late nights and all that, and worked the weekends, is also a desire to be there for kids. So I run the goalie program at our hockey club, and that means a lot to me. I spend a lot of time on it. I'm on the ice probably 4 or 5 hours a week with the kids, and it's awesome. I enjoy it. My son's a goalie too, so it helps me spend time with my son. Mm-hmm. My daughter's aged out of me being her coach, so she's still playing. And for Bryce, it was time with his daughters in soccer. I think he's coaching basketball right now, if I remember correctly, with them. And so it's given us a lot of time to be present with our families, which we both wanted. And then now as our kids are getting older, and I think about like the next act, they're not going to want to spend so much time with us. And so that's where kind of taking these skills we've honed around technology development, especially with AI and the kind of the new opportunities out there, and looking at some of these bigger deals, which we've been doing recently, is how do we keep kind of growing more in that avenue while still being open to some of the smaller deals, which have been, a way that's laid a nice foundation for us.
I love to hear an entrepreneur embrace lifestyle and a type of business that is crafted to work with a particular lifestyle.
Yeah.
People are too shy about that point, and it's a powerful one, especially when it involves kids. Well, Dan, on that point and on just your kind of tech forwardness as a sponsor, you're a really different flavor of guest. So we've really enjoyed having you. Thanks for coming on and sharing with our audience.
Oh, thank you guys. Really appreciate the time.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.